The idea that the 2025 housing crash is somewhere off in the future is outdated. It isn't approaching anymore. It's already unfolding in real time. And we're about to walk you through 10 cities that appear to be next in line for serious trouble. All around the country, warning signals are flashing bright red, yet most people aren't paying attention. In one city in Florida alone, we uncovered a deeply unsettling trend. Roughly 8% of homeowners already owe more on their mortgages than their properties are currently worth. And here's the part that really catches people off guard. This city doesn't even rank as the worst case we've found. That unfortunate title belongs to a market that shed more value in just 1 month than many cities lose over the course of an entire year. But there's one particular red flag that should send chills down the spine of anyone who owns property or invests in real estate. A high-end waterfront estate has dropped by $3 million in value in under 2 years, and the sellers are still struggling to unload it. This isn't some forgotten town in a shrinking industrial region. This is happening in a location that was once marketed as the ultimate American retirement haven. And if you're feeling confident that your city is immune, you may want to think again. We're about to reveal 10 housing markets where danger signs are everywhere, where experienced investors are quietly pulling their money out, and where the next phase of the housing downturn is likely to hit with the most force. By the time this video ends, you'll clearly recognize which cities are displaying the same troubling patterns we spotted months before Austin and Tampa began their dramatic slides. The markets we're talking about today haven't fully collapsed yet, but every major indicator suggests they're right on the edge. At this moment, 105 out of the 300 largest housing markets in the United States are seeing prices fall compared to last year. Even more concerning, that figure has risen steadily, climbing from just 10% in January to 35% by September of 2025. We've spent more than 10 years studying real estate cycles, and we're not here to sugarcoat what's happening. Cape Coral, Florida has experienced the steepest drop so far, with home values falling by just over 9%. Austin, Texas, and Tampa, Florida are also trending downward, along with 7 out of California's 10 largest housing markets. Today, we're breaking down 10 cities where the data tells a clear story, places where everyday families are watching their hard-earned equity disappear, and where the promise of homeownership is quietly slipping away. These aren't guesses or hypothetical scenarios. This is the current reality, backed by the latest numbers from Redfin, Zillow, and respected industry analysts. Whether you're planning to buy, preparing to sell, or trying to make smart investment decisions, understanding what's truly happening in these markets is no longer optional. It's essential. We're kicking off our countdown at number 10, starting with Denver, Colorado. What's unfolding in Denver is far more serious than most people realize, and honestly, even we were surprised when the newest data came in. Denver, Colorado is no longer riding the momentum it once had during the pandemic boom. Denver, Colorado is now showing clear signs of a market that expanded too fast and is struggling to find its footing. An astonishing 91% of homes across the Denver metro area lost value between November 2024 and October 2025. Let that sink in for a moment, because it's not a small shift. That means nearly 9 out of every 10 homeowners in Denver are sitting on less equity today than they had just a year earlier. On top of that, the city recorded a sharp 6% decline in just a single month, dropping between December 2024 and January 2025 alone. That kind of month-to-month movement is rarely a good sign, especially in a market that was once considered resilient. It signals that the slowdown isn't gradual, it's accelerating. We've also been hearing the same concerns repeatedly from local Denver real estate agents. According to them, the remote work policies that fueled Denver's explosive pandemic-era growth are unraveling much faster than anyone expected. Many of the workers who relocated during that boom are now being called back to the office. A large number of former California residents who moved to Denver believing they'd found the ideal work-from-home lifestyle are facing a harsh reality. Their employers want them back in Silicon Valley, but selling their Denver homes isn't so easy anymore. Many are now locked into mortgages on properties worth far less than what they originally paid. At the same time, they're dealing with Denver's long, unforgiving winters without the lifestyle upgrade they thought justified the move in the first place. The combination of falling home values, reversed remote work policies, and unmet expectations is putting serious pressure on the Denver housing market, and that pressure is becoming harder to ignore. Coming in at number 9 on our list is Orlando, Florida. And this is where the broader correction across Florida really starts to become impossible to ignore. Denver, Colorado may be getting the headlines right now, but similar warning signs are spreading far beyond the Mountain West. Denver, Colorado serves as a reminder that once momentum fades, even popular destinations can turn quickly. In Orlando, home prices slipped by 0.07% month over month, a small number on the surface that masks a much bigger issue underneath. Across the state, 10 different metro areas in Florida reported declining home prices in the first quarter of 2025 alone, showing that this isn't an isolated blip. At first glance, that might not sound alarming, but the real story isn't making the headlines. Theme park attendance has yet to rebound to the levels analysts projected before the pandemic, and Disney's most recent earnings calls have carried a noticeably cautious tone when it comes to future expansion. That hesitation matters in a city whose economy leans heavily on tourism and entertainment. Just last week, we spoke with a longtime Orlando real estate investor who shared something genuinely unsettling. For the first time in 2 decades, he's watching vacation rental properties sit vacant for weeks at a time during what should be the busiest season of the year. That's a major red flag in a market built around short-term stays and constant visitor traffic. The strain is clearly showing in Orlando's hospitality-driven economy. And when you layer that slowdown on top of Florida's ongoing insurance crisis, the outlook becomes even more concerning. Rising insurance costs combined with weaker demand create the perfect conditions for further declines ahead. Before we move on, take just a moment to help us out by hitting the like button and subscribing if you're finding this breakdown useful so far. Every like, share, and subscription directly supports this channel and helps us keep producing in-depth content like this. We truly appreciate it. Now let's keep the countdown going. Number 8 on our countdown is Sacramento, and this city is a perfect example of just how fast the real estate story can flip. Denver, Colorado, showed us how quickly momentum can vanish when conditions change. Denver, Colorado also proves that markets built on temporary trends are often the first to feel pain when those trends reverse. In the Sacramento metro area, a staggering 88% of homes lost value between November 2024 and October 2025. That kind of widespread decline signals a market-wide shift, not just a few struggling neighborhoods. It's a dramatic contrast to the optimism that once surrounded this city. At the same time, Sacramento saw the largest surge in new listings, with inventory jumping 31.7% compared to the same period last year. That spike in homes hitting the market speaks volumes about how sellers are feeling right now. Fear is setting in, and many owners are rushing to list before conditions potentially get even worse. The mass migration narrative that once pushed Sacramento home prices up more than 70% during the pandemic has completely unraveled. The idea of escaping the Bay Area for a cheaper, remote work-friendly alternative no longer holds the same appeal. What once looked like a permanent shift is now proving to be temporary. According to local agents, many remote workers are packing up and heading back to San Francisco and San Jose, drawn by higher-paying in-office positions. That return migration is leaving Sacramento flooded with homes that were purchased at the absolute peak of the market. For sellers, the situation is grim. They're being forced into a difficult decision: accept a steep loss today or hold on and hope for a rebound that may take years, or may never arrive at all. Holding the number 7 position is Jacksonville, Florida, and this market puts Florida's larger housing troubles into sharp focus. On the surface, prices appear stable, with the median home value holding steady at around $390,000 and showing little change from the first quarter of 2024. At first glance, that might seem reassuring, but the deeper data tells a very different story. Here's where the concern really starts to build. Pending home sale prices in both Jacksonville and Tampa have been trending downward consistently since the beginning of 2025. When pending sales weaken like this, it's often an early warning sign, one of the clearest indicators that actual price declines are likely coming next. Jacksonville is also dealing with the same insurance crisis hitting the rest of Florida, but without one key advantage. Unlike markets such as Naples or Miami, Jacksonville doesn't benefit from a high-end luxury premium that can cushion rising costs and soften downturns. That leaves homeowners more exposed when conditions worsen. The job growth that was supposed to support this market hasn't shown up the way many expected. Banking and logistics positions, which were heavily marketed as Jacksonville's growth engines, have failed to materialize at meaningful levels. Without that economic momentum, demand simply isn't keeping pace. At the same time, inventory levels have climbed to heights not seen since 2019. More homes, fewer motivated buyers, and weakening pending sales all point in the same direction. The message is becoming hard to ignore. The warning signs are already written clearly on the wall. Coming in at number 6 is San Antonio, Texas, a market that's been showing up again and again on multiple housing downturn watch lists we closely follow. This isn't a sudden development either. It's been quietly weakening for some time. Between December 2024 and January 2025 alone, San Antonio posted a 0.1% month-over-month decline, adding to a growing list of negative signals. According to Redfin data, San Antonio is now tracking closely behind Austin as prices continue to trend downward. That comparison alone should raise eyebrows, given how sharply Austin corrected once momentum turned. But what truly sets San Antonio apart, and not in a good way, are the deeper structural issues emerging beneath the surface. San Antonio currently has the slowest average time to sell in the entire country, with homes sitting on the market for about 83 days. On top of that, closed sales are down 10.3% compared to last year. When properties linger this long without buyers, it points to more than just seasonal softness. There are also broader economic pressures weighing on the city. Uncertainty around military spending, combined with unsuccessful attempts to diversify the local economy, is creating meaningful resistance to growth. For years, San Antonio has struggled to reduce its reliance on military-related employment and tourism, and that lack of diversification is now becoming a liability. We've been monitoring this market for a long time, and these patterns are hard to dismiss. When homes are taking nearly 3 months to sell, that's not the sign of a healthy or orderly correction. It's a signal that buyer demand itself is breaking down, and that kind of damage doesn't resolve quickly. Landing at number 5 is Tampa, Florida, a market that has been making headlines for all the wrong reasons. In fact, Tampa just posted one of the sharpest short-term drops we've seen anywhere in the country in recent years. In January alone, home prices fell by 1.6% month-over-month, the steepest decline nationwide during that period. To understand how dramatic that is, consider this. The median home sale price in Tampa dropped to roughly $408,500 in January, a far cry from its peak of $499,450 back in June 2024. That represents a drop of nearly $91,000 from top to bottom in a very short span of time. Moves like that don't happen in stable markets. Inventory is also quietly building pressure. Data from the Federal Reserve Bank of St. Louis shows that active listings across the Tampa-St. Petersburg-Clearwater metro area climbed to 15,932 homes, up from 15,748 just a month earlier in December 2024. That may seem modest, but rising inventory during falling prices is rarely a good combination. But the most telling number, the one that really explains what's happening, comes from insurance costs. The average homeowner in Tampa is now paying about $5,165 per year to insure a $300,000 home. That's $2,661 higher than the national average, and it's pushing ownership costs into dangerous territory. When insurance premiums rival or even exceed monthly car payments, affordability breaks down fast. Buyers don't just look at purchase price, they look at total monthly cost. And in Tampa, that equation has shifted so dramatically that demand is starting to pull back in a very visible way. Taking the 4th spot on our list is San Francisco, and this is proof that even the heart of the tech world isn't protected from this downturn. Denver, Colorado showed earlier how fast confidence can erode once demand weakens. Denver, Colorado also reminds us that high-income markets are not immune when affordability and job trends shift at the same time. Across the San Francisco-Oakland-Fremont metro area, home prices dropped 10.5% year-over-year through November 2025. That makes it the second-largest annual decline among major U.S. metros. On top of that, prices slipped another 0.28% month-over-month, reinforcing the idea that this correction is still very much in motion. This is also the moment where we circle back to that second mystery mentioned earlier. Remember the luxury property that lost $3 million in value? While it isn't located directly in San Francisco, the broader Bay Area downturn is producing similar stories throughout the region, especially at the high end of the market. The long-anticipated return-to-office push hasn't played out the way many expected. Commercial real estate remains under serious pressure, and a growing number of tech firms have permanently scaled back their Bay Area footprints. That loss of high-paying, location-anchored jobs is having a real impact on housing demand. Even after such a steep correction, San Francisco homes are still far out of reach for most Americans. That leaves sellers dependent on a very small pool of wealthy buyers, and when that narrow group hesitates, the market has very little support underneath it. Sitting at number 3 is Phoenix, Arizona, and this is a market where the downturn is picking up speed in a way that should worry anyone exposed to desert boomtowns. Denver, Colorado gave us an early look at how quickly growth-driven markets can lose momentum. Denver, Colorado also highlighted how fragile demand becomes once migration patterns reverse. Across the Phoenix-Mesa-Chandler metro area, home values fell by roughly 10.4% year-over-year, and an eye-opening 86.9% of homes lost value between November 2024 and October 2025. That level of decline isn't isolated. It's widespread and systemic, touching nearly the entire market. But what really raises alarm bells here isn't just price data, it's the demographic reversal happening underneath it all. Net domestic migration collapsed from about 32,600 people in 2022 to just 1,800 in 2024. That abrupt drop effectively ends a 13-year streak of steady population growth. When a city that's been expanding for more than a decade suddenly stops attracting people and even starts losing them, that's not a short-term fluctuation. It signals a deeper structural change that housing markets rarely recover from quickly. Demand weakens, confidence fades, and prices adjust accordingly. Inventory numbers confirm that shift. Homes for sale jumped to 14,767 in early 2025, up sharply from 9,980 in 2024 and nearly 4 times higher than the pandemic-era low of 3,330 in 2022. The equation here is straightforward and unforgiving. Fewer buyers, more listings, and downward pressure on prices. Taking the number 2 spot is Austin, Texas, and this is where we finally confront the jaw-dropping detail I teased earlier. Remember when I said the market experiencing the most severe declines wasn't the one most people expect? This is exactly what I was referring to. Austin recorded the steepest month-over-month home value drop in the entire country, with prices falling by about 1.04% in a single month. Looking at a broader time frame makes the picture even clearer. When you compare October 2024 to October 2025, typical home values in Austin fell by more than 6%. This is the same city that was once held up as the ultimate pandemic success story, the poster child proving that a major tech hub could thrive outside Silicon Valley. That narrative has now completely unraveled. Since peaking in 2022, Austin home prices have plunged by an astonishing 14.8%. As return-to-office mandates pick up and many workers relocate back to their original cities, supply has surged and buyer demand has weakened. The imbalance is becoming harder to ignore with each passing month. On paper, median prices currently sit around $429,869 in the first quarter of 2025, down from roughly $440,000 in the first quarter of 2024. But those numbers only scratch the surface. They don't capture the full extent of the financial strain many individual homeowners are feeling after buying near the peak. And with that, we arrive at number 1, which brings us full circle, back to the statistic I opened with at the very beginning. This final city ties together all the warning signs we've been laying out so far. Claiming the number 1 spot is Cape Coral, Florida, now standing as the most distressed housing market in the country. And this is where the statistic I opened with becomes painfully real. Nearly 1 out of every 10 homeowners here is underwater on their mortgage. Let that sink in for a moment, because that level of distress is unmatched anywhere else in the U.S. Cape Coral has posted a 6.5% year-over-year price decline, a sharp contrast to the national average, which is still showing roughly 2% growth. When a single market moves that far in the opposite direction of the country as a whole, it signals something deeply broken at the local level. Denver, Colorado, showed us how fast sentiment can flip. Denver, Colorado also reminded us that once confidence breaks, declines tend to accelerate rather than stabilize. Here are the numbers that should seriously concern anyone who owns property in this area. 8% of homeowners are underwater, the highest share in the nation, and home prices have fallen in 12 of the past 13 months. That's not volatility, that's sustained deterioration. Home values dropped 5.6% overall, sliding from $394,744 in December 2023 to $372,481 by December 2024. At the same time, for-sale inventory exploded, jumping 37.7% from 8,449 homes to 11,639 listings. More supply, falling prices, and weakening demand are forming a perfect storm. This is also where that luxury property story comes full circle. A waterfront mansion in Cape Coral was originally listed at $11.9 million in late 2023. It was later relisted at $10.9 million for several months and is now sitting at $8.9 million, a $3 million haircut in under 2 years. That kind of loss used to be unthinkable in this market. But this isn't just about charts and percentages. It's about real families watching years, sometimes generations, of hard-earned wealth evaporate. Insurance costs in Cape Coral have become downright punishing, especially after Hurricane Ian exposed risks that insurers can no longer ignore. According to Parkle Labs, 52% of homes in this market have already undergone price cuts. When more than half of sellers are slashing prices, you're no longer looking at a healthy correction. You're witnessing capitulation. So what does all of this mean for you, whether you're buying, selling, or investing? For buyers, these are the most favorable conditions we've seen in years, but only if you're disciplined and strategic. Active inventory rose another 29% in June compared to the same month last year, giving buyers real leverage that simply didn't exist during the pandemic frenzy. That said, focus on markets where price declines are driven by oversupply rather than deeper economic weaknesses. Be especially cautious in areas facing extreme insurance hikes or long-term climate risk premiums, because those costs are unlikely to improve over time. A cheap home can quickly become an expensive mistake. For sellers, the era of listing high and waiting for bidding wars is officially over. Nearly 20% of listings saw price cuts just last month, and 37% of builders are now lowering prices by an average of 5%, the highest level since tracking began in 2022. Pricing realistically from day one is no longer optional. In markets like Cape Coral and Austin, homes that are priced correctly are still finding buyers. Overpriced listings, on the other hand, are sitting for months while sellers slowly adjust to a new reality. Time is no longer on the seller's side. Zooming out, it's important to understand that this is not a nationwide housing crash. About 68% of major markets are still seeing price growth. But for the cities experiencing declines, this marks a real shift in supply and demand fundamentals, one that smart money has already noticed and is positioning around. Whether you're buying your first home or your 10th investment property, understanding local market dynamics has never been more critical. The housing market isn't one national story. It's more than 300 individual markets, each shaped by its own economic forces. What we've shown you today proves that location truly is everything. And right now, being in the wrong location could cost you far more than you ever expected. If you found this breakdown valuable, please subscribe, share, and check out the next video as well.